Well. Good evening to all you great people as I adjust my camera, get my camera right. This is Dr. Gregory Clarke Sr., and as always, it's a great time to be with you for the Comeback Conversations with Dr. Clarke. And for those of you who were here, some of the members of the Comeback Collective Circle, I always play a little music before we start the recording just to set the vibe. And, I'm in my Afro house vibe. That's where I'm at right these days. Not just, it's just, a different type of vibe, just different type of vibe. I'm very culturally abound and I don't make no disseminations about that or minimizations about that. And I love us. I love what we at times can have the ability to create. And we will always express that in some type of way. And I thank you because tonight we're going to be dealing with part three, the last part. We've already had two great parts in regards to dealing with index universal life insurances, and those type of insurances are shared globally. So this is not just a conversation for us here in the United States. This conversation has been about, figuring out how you can utilize this as a part of your wealth strategy. And as we're about to jump in to the teaching for tonight, I just wish to greet and thank all the members of the Comeback Collective Circle who are in the building. And, even one of the members, Ms. Nicole Johnson, who you've heard her voice plenty of times and share plenty of times, added some great value to today's presentation. So I can't wait till we get to that part when we get to that graphic that gives a little breakdown of just not only index, but then, universal life. And, it was just nice. It was a nice little cherry on top. You always got to acknowledge your team. You got to acknowledge the people who are part of your community, because there are too many times that leaders or people who are creating communities or building communities could always attempt to always pull everything to themselves as if they are the end all be all. And when you start to acknowledge the fact that, you have some great people on your team, regardless if they give you feedback, regardless if they add value to the presentations, regardless if they add to the conversations like most of the members of the Comeback Collective Circle does, then it feels forthright, it feels powerful, and it feels welcoming. So, let us get ourselves prepared to jump into this now. Yes. Click the share button. Let's go. Let's go. We don't have to belabor long. We do not have to belabor long. Amen. Let's get this slideshow working. Let's get this slideshow working. And of course, always ask Miss Johnson, can she see my screen? Can she see my screen? Can she see my screen?
I'm waiting for the rest of the title to pop up.
There we go. How
Yep.
now?
Now we're good.
Okay, good. Even though I don't like the fact that premium found its way behind one of those pictures, but I'll read that one. So I'm going to ask Miss Johnson. She's going to read the first one, the third one, and the fifth one. So that means she'll be reading flexible premiums, investment flexibility, and less risk. And I will handle 2, 4, and 6 as we talk about some of the advantages of index universal life insurance. Now, if you missed some of them, you can always go back on my YouTube channel at Dr. Gregory Clarke Master Coach, and you can catch up on some of the replays, because that's the main reason why we record them, because it's not something just to do a teaching or have a conversation and it just disappears without some level of saying, wait a minute, I can reference back to some of the stuff that they talked about. It's not just only what I'm talking about, because it's not a monologue, but as a dialogue. So without further ado, I'll put it in the capable hands of Ms. Johnson, who's going to talk about the first bubble there, flexible premiums.
Flexible premiums. The policyholder can increase their premiums or lower them in times of hardship.
And see, that's one of the great things about, especially if you're an entrepreneur, if you're a world business. That's why people who have some sort of assets love these type of insurances. When you hear sometimes some of these people on these social media streets, saying that, turn yourself in a bank. In some ways, they're legitimately, this is what they're talking about. This is one of the ways that you can in theoretical terms, allow yourself based upon what you're putting into it as an investment, not only as looking for a death benefit, but from the standard of because of the amount that you put in or whatever type of level of policy you have the ability to borrow against it. Or at times, if you were doing excellent in a particular year, all of a sudden you go to a down year, it's like, okay, I built up enough cash value where now, I may not have to send the premiums in some months. That's a flexibility that you will never get from a term life insurance. Most term life insurances, I would say from my standpoint, I'm not here to tell you what to do, but I know from my perspective, if I'm talking to Dr. Clarke in the mirror, I would never touch a term. I know you may have some financial experts out there who say term is great and stuff like that. No, I don't necessarily agree. And that's just my standpoint. I'm not saying that they have the right to their viewpoint, but for me, the term life insurance doesn't really benefit you unless you expect to die off in the years of the term. Now, if you're expecting to be around, you're expecting to have a quality of life, you're expecting to have some longevity, I would never tell anyone to get term. I would say start making the necessary investments. Oh, that means I may not have as much fun. Good. Keep investing in yourself. You don't need as much fun. There's enough streaming services and streaming apps that you don't need to go out there and circulate your dollars and all of a sudden have empty dollars that don't mean you any good. Make the investment yourself. Get it a little younger. Yeah. It's going to cost you. Oh, wait a minute. The caveat is, I don't get to hang out or go out with my friends, but I'm investing in something that can benefit me in the long term. Think about your long-term growth. So that's one of the great advantages of having an IUL. You have the opportunity to say, you know what, we're not doing as good. Maybe I can pull back on some of my, cash flow or what I'm working with in resources, and I still have that opportunity, still hold on to this type of policy. Now, cash value accumulation. Amounts credited to the cash value grow tax deferred. The cash value can also pay the insurance premiums. And that's what we're talking about in regards to what Ms. Johnson uttered about the flexible premiums. If you have enough cash value in this type of insurance policy, that the stock market is doing good and things of that nature, and all of a sudden the cash value is just growing in a definitive way, and all of a sudden like it offsets, like, wait a minute, okay, 1 or 2 months the insurance company might say, no, you don't necessarily say, send us any premiums. The stock market has been doing well enough, and based upon which particular index that you allow this particular policy to invest in, and you have a hell of a return. So, you may not have to say anything this month. Okay, we'll see you next month. Or sometimes, even if they've received that information, they'll still put something into it, because what's going to end up happening is if you keep putting more your premiums in, it's going to keep working. It's like anything. If you find a field, you purchase the whole field, and you keep cultivating the field, and all of a sudden the field keeps generating a tremendous yield. It'd be crazy if you just say, oh, we got a great bounty here in this 1 month. We're going to stop next month. No, rinse and repeat. Keep it moving. Keep it pushing. So, Ms. Johnson, let's go to investment flexibility.
Policyholder controls the amount the policyholder controls the amount risked in equity indexed accounts, and death benefits amounts can be adjusted.
Now, this is another benefit of the IUL. Say, you desire the fact of allowing the fact that you may lower the death benefit because you want to accentuate the possibilities of the tax deferred status. Because when I read in cash value accumulation, it's growing tax deferred. That means the government's not in your pocket, technically, even though it's an investment level insurance policy. Yes, there's a death benefit account to it. God forbid something happens to you. Okay, the people, based upon the amount that's already situated, and it probably may have grown because the cash value has added some particular space within it, and all of a sudden, that can be adjusted. You may have borrowed some cash value over the course of the life of owning this particular policy, that you've been able to maybe accumulate some other assets. And you may have less of death benefit, but then your family's going to be happy that, oh my God, Grandpa Jones or Grandma Sue decided to borrow against this death benefit. We got less money when she transitioned, but she took that money, or he took that money, and bought X amount of assets. And you start to recognize, like, wait a minute, oh, we may have gotten less of a death benefit, but when she borrowed against that, and she took some of that cash value and made investments over here, it probably worked out even better for long-term stability. And that's how the affluent and the wealthy do it. Not being rich. If you wondering why I'm making that distinction, we went through that a couple of weeks ago. The difference between rich, wealthy, and affluent. And too many times, too many people who look like me, especially in our community, desire to be rich. That's not where you should be aligning yourself or looking to be. You should be looking to be like, wait a minute, how am I becoming wealthy and then eventually end up being affluent? Being rich means, okay, you can be that individual, as we talked a couple of weeks ago, you can be making six figures a year and still living paycheck to paycheck. That's rich. That's rich. So now I'll go to death benefit. Permanent, not subject to income or death taxes, and not required to go through probate. I don't know why I doubled up. Maybe that's probably like as Miss Johnson was reading, doubled up somehow. But think about it. The death benefit, it's not subject to income tax. So that means you already know that your beneficiaries are not going to sit there cursing you out because you gave them something that the government can have their hand out. No, government can't have their hand out on it. Doesn't go through probate. It doesn't have to. You don't have to go through that crazy process. The insurance companies be like, look, this is what this individual set up. Boom, here's your check. You checked out. Okay, this person has transitioned. That this, that, a third. Blah 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 blah. They go through the necessary process. You present the death certificate, and all of a sudden you get a check. It doesn't go through all that long process. People who are moving in those wealthy and affluent spaces don't necessarily want to go through all that rigmarole. That's why when you start hearing about trust, that we will get down the road during this dynasty path, we're going to talk about trust. We're going to talk about some of these different areas and different spaces and places and things like that. You hear, what's a trust? Why people talk about trust? There's a reason for that. There's a reason what the rich, well, someone who's seen themselves as rich and starting to move towards wealthy, they would start thinking about trust. And definitely the wealthy and affluent think about trust all the time. Because it's okay to control everything, but not have everything in your name. But we're here to talk about IULs today, so we won't get off that soapbox. So, Ms. Johnson, we are at less risk.
The policy is not directly invested in the stock market, reducing risk.
That's why the I in IUL is so important. It's index. That means they're probably doing ETFs. That means they're doing index funds. It's not going in one particular stock company, even though it is an investment. ETFs are electronic traded funds. And I'll probably ask Ms. Johnson if she can find that real quick so we can share with the people when we talk about ETFs, so you can become much more aware. You become much more knowledgeable. So you don't hear us say these acronyms like we're attempting to be smart. Oh, I know what an ETF is. Or I know what EBITDA is, and this, that, and the third. And it's like, wait a minute, what are we saying? And those are the things that I talk about when it comes to financial literacy, especially in Black and Brown communities. Those things are not talked about for us. Because as always, they usually just desire for us to be just consumers. Go look good, but you're still redline. Be a permanent renter. Don't think about owning real estate. Don't get in the stock market because it's risky, but these are the people in the stock market and why they worth billions and trillions of dollars. What kind of mess? What kind of utter foolishness? No, we changing that dynamic here, especially as a part of the Comeback Collective Circle. And that's why the men and women who are a part of the circle, it's about us developing, having these relevant conversations and recognizing, wait a minute, we need to be abreast of these things. Not just to say, oh, I heard about it one day. No, no, no. This stuff has to be in the current. It has to be in your current vernacular. Anything that you're not talking about, anything you're not willing to research, anything that you're not willing to delve into would not become a part of you. So before we go any further, Ms. Johnson, you have anything about ETFs? So we don't just throw out that acronym and people won't feel like we're losing them.
Sure. An ETF is an exchange traded fund. It's a type of investment fund that holds a collection of assets like stocks, bonds, or commodities and trades on the public stock exchange just like an individual stock. Couple key points. Unlike mutual funds, which trade once a day, you can trade ETFs throughout the day, and it offers diversification. Because the ETF holds several different assets, it spreads out your risk. I'm complete.
Thank you. So sometimes, in other platforms, you may have heard, certain ETFs that have been shared, and I know ETFs are part of my portfolio. I have some ETFs now that I'm holding on to, and I love the fact that when I see those dividends come in, and I don't take those dividends for me to circulate. No, I take those dividends to keep reinvesting. You've heard me say, I've coined that phrase, pregnant money. No, you got some dividends. Oh, what you gonna do with these dollars? You gonna go out there and no, I don't need to circulate another penny on something that I may not necessarily need to impress someone that I don't need to impress. You go back out there and go back to work. Oh, so by me, you sending me back out there on the stroll. Okay, on that stroll, you make some money and come back pregnant. Maybe a week or 2 weeks or whatever it is, whenever the next dividends come through, it's like, oh, you took those previous dividends, you got some more funds and you got some more, possibilities. And next thing you know, they go back out there to work. They work prominently and powerfully and they come back. Oh, your dividends went up. Okay, keep going and keep going. This is compound interest. So if you start to hear, and we're going to get into like certain things about certain stock terminology and stuff like that here as we go through this particular year. So we're giving little Easter eggs along the way. So we're not just sharing information, but we desire for you to embody it. Anything that I share here, especially on this platform, is not just to say, oh, they just talked about that and that was the end all be all. No, it's about you embodying it. Take the research, find out about it. Don't get caught up in the number of your age. Because like I will always say, there's no old people. We're all getting older. That doesn't make you old. Your ability to navigate and to move around is always based on your mindset. So please never look at yourself as old. If your body's not acting the way it is, figure out how you can get it, start moving, get in some level of movement. None of us were never meant to be sedentary. So just that's something to think about. And number 6, easier distribution. The cash value can be assessed at any time without penalty, regardless of a person's age. And why is that so powerful, Dr. Clarke? You hear people who have these type of insurances, and by the time we get to the graphic, you'll see why. Save your cash value, save the cash value in a particular IUL. You have 60, 70,000, and all of a sudden you have the opportunity to jump into an asset making possibility that may cost you 30,000. Instead of you going to the bank, have your hand out and hoping that they approve it. You made the investment in this particular insurance policy. You borrow again, you tell the insurance company, look, I have this amount in cash value. That's dollars that are just sitting there. That's accumulating based on the fact that they're in the right ETFs and you pick the right index fund for them to invest in, and it's generating a great return. You just got some money that's just sitting there that's waiting for you to say, what you gonna do with me? Next thing you know, you take that 30,000 out of the cash value, you go purchase that income producing or asset producing whatever. All of a sudden, you choose to start paying yourself back or you choose not to. But now you have this asset that hopefully is, since it's income producing, hopefully it's starting to give you some pregnant money. And then what you do with that pregnant money? Maybe some of that part of that pregnant money, you start paying back the cash value in stock. Or maybe it's enough pregnant money, you're paying back the cash value on this particular policy. And then on top of that, then taking some of that money and go and find something else that can be an asset producing resource. That's how the wealthy and the affluent do it. The reason why I'm not talking about the rich, because the rich are still in the space where, as we talked about, and we may do that as part of the conversation as a Q&A, is that you could be making six figures and still living paycheck to paycheck. That's not what the wealthy and affluent do. The wealthy and affluent are already at a stage where, look, we recognize how this stuff works. And even if they're living on dividends, you got some people who live off their dividends, that they never touch principal. That's when you're wealthy or affluent. Rich means you still, as Shaq learned, and we brought that up a couple of weeks ago as well. When Shaq signed his first free agent deal with the Lakers in 1996 and understood the fact that, wait a minute, Dr. Buss is able to sign me to a 7-year, $120 million contract that he just made me in the space of starting on the cusp of being wealthy, because remember, tax is going to take at least 40 to 50% of that, especially depending upon what state you live in here in the United States. So, it's still a nice piece of chunk. And so what do you do with that? This person is able to pay me X amount. Wait a minute. This person is able to pay me a 9-figure contract. And that was the first time he finally had his aha moment. As anyone who has followed Shaquille O'Neal now, Shaquille O'Neal has got to the Lakers, got around Dr. Buss, got around Magic Johnson, started listening and learning. And right now, he does has his doctorate degree as well. So I can call him Dr. O'Neal. And this man has created a portfolio which he's left money for his children's children. Shaq is definitely in the affluent class, where even the stuff that he does, he's doing it out of love. That's when you know that you're affluent. When you're rich, you may have a great salary, but someone fires you or someone ends your contract, you start to recognize, oh, you may not be as rich or as wealthy, or you thought you was wealthy. No, you're just rich. So the gaze is not about being rich. It's about recognizing the movement and spaces of being wealthy. So any questions before we move on from this slide? Would love to open up conversation. Any questions, any thoughts, anything that pops up on the screen that you may have a question about. So we're not running through it. We're giving you the opportunity to learn, to be exposed, and we definitely desire for you to get it. Okay, hearing no voices, we're gonna move on. Now we're gonna talk about, hello? I thought someone was speaking. Now we're going to talk about the disadvantages. The last screen was about the advantages. Now we're going to talk about the disadvantages. There are disadvantages. Disadvantages are not bad things. See, sometimes we can get caught up in words that make it seem like, oh my God, we're going to talk about the disadvantages. Then we're going to talk about all the bad things. Disadvantage is not a bad word. When you allow yourself to be in a space when you're deductively reasoning and putting your critical thinking hat, you have to weigh out all the options. There's no perfect thing. And sometimes certain things are presented to us in that pedagogy of oppression where it can position us like, oh my God, we're going to talk about the bad things. No, I'm not going to do it. I just turned my hearing off from that. And it's like, why did you do that? Why? Because maybe the threshold of the money that you have to invest, you can't afford it. Then say that, but don't make the thing bad. And that's why I always go back to something that Reverend Ike says. He says, you don't talk about the rich in a negative manner because then you won't be like one of us. And as we can even go in scripture, especially in the First Testament, when you start looking and breaking it down from a biblical standpoint, being wealthy is not a crime. It's not against God. So sometimes we got to get all those cobwebs and stuff, sometimes very colonial thinking out of our heads. Now, we're not sitting here loving money. I don't love money. I know money is a tool. That's when it becomes the root of, oh my God, I'm putting money above God. Now you have a problem. Now you acted a little suspect because now you're putting the tool over the essence. The essence is always first. So as we did in the previous slide, I'm going to ask Miss Nicole to read 1, 3, and 5 while I read 2, 4, and 6. And she's going to start with caps on accumulation. I don't know why they kept doubling that. I got to figure that out. That must have been the one that brought it over. So you
Caps
may
on
be.
accu-
Mhm.
oh, sorry. Caps on accumulation. Insurance companies. Insurance companies set a maximum participation rate that is less than 100%.
And so why is that so important? Because, they don't want to put themselves in a space where it's like with any bank. Think of it as most banks won't put 100% of their deposits at work because they know legally they have to keep some of those deposits as a reserve, just in case if some of their loans that they may have put up or maybe some of the investments came back bad. Okay, and someone comes in and says, "Yo, I need my money." You can't sit there and say, "Oh, we ain't got all your money. All your money has been sent out to work." No, you have to have some sort of reserve. How are you going to pay your workers? How are you going to keep these lights paid? What your responsibilities, things of that nature. So yes, there's a check and balance. So it will always be less than 100%. They'll always keep some level of cash reserves on hand because that's just the cost of doing business. They're not stealing. They're not doing something that's bad. They're not doing something that's off. You should be doing that. And that's even from a biblical perspective. Where's your reserve? Where's the stuff that you're supposed to glean from the corners on and put to the side? Where's the stuff that even you're supposed to be sharing for those who are less fortunate, which are your alms? But then when we start talking about that, it becomes a different conversation. But then when we look at an insurance company or a bank or being a borrower instead of the lender, you got to recognize your part to play in it. But part of it is based on the fact that financial literacy has not been really propagated in our community. And now that we're getting ourselves aware of it, we will get better, especially if you're part of this platform. So, number 2, better for large face amounts. Smaller policy face value don't offer much advantage over regular UL insurances. Let's see. Someone has a question. Let's see. The Bible advises us to learn from ants. Yes, they do, Miss Clarke. Yes, they do. Ants work together. As you know, that's a good segue. Ants do work together. Ants do know how to save. Ants know how to put certain things away and to utilize what's needed. Ants know how to work in community. So, yes, that is a great example of why there's so many times the animal kingdom sometimes has it much better than us as humans. Let's see. Amen. Thank you, Miss Levy. Consider the ants. Consider them. Oh no, they're ants. Let me just stomp on them. Says you're not wise. Because just because you have the ability to do something doesn't make it beneficial. Oh no, I'm a human. I can just stomp on them. So why would you stomp on them? And my wife knows that about me. There can be times we're in a road and I'll swerve. She'll see like it's something, and she knows me. I love animals, and I'll swerve past maybe something that I see on the road, or maybe an animal scurrying by. And say, oh no, no, because when you have true power or you have a responsibility, now you become responsible enough to says, wait a minute, just because I have power, I have access to something doesn't mean that you just do things from a space that's not beneficial, just only for yourself. That becomes very, very selfish. But when you think about others, the universe has a funny way of making sure that it thinks about you as well. So if you have a smaller policy value, so that means if you're out there trying to get an IUL for 100,000, um, you can, but That's where it comes into place. You might as well just get a regular universal life, which is the next step over past whole life. Now, as when we get to that graphic, Ms. Johnson was able to be a blessing and add value to this presentation. You start to see what happens when you look for that at least $1 million policy value or above, and how it can work for you. So, Ms. Johnson, let's read the third one.
Based on variable equity index. If the index goes down, no interest is credited to the cash value. Growth doesn't include stock dividends.
Now, think of it that way. So that means they pick something that particular index fund is not doing that good. They may not be crediting interest to your cash value at that particular moment. Like these past couple of weeks, if you're in the stock market, yes, stocks have been acting funky. And that's because, we have an orange man in office, but we're not going to go there. We're not going to go there. Please, for the love of God, we're not going to go there. But eventually, as certain things are starting to get themselves back to some space of the right individuals are starting to make the better decisions and be like, yo, we shouldn't be being the aggressor. And maybe we need to, figure out how we can minimize this thing. Because, people are starting to complain about, when gas prices jump up 80%, 80 cents in 1 week, that's a problem. It's a major problem. Because that cuts into now all the other stuff that you desire to do as a part of your day and day and movements. And then you start affecting socioeconomically, geopolitically. But we're here to talk about IULs today. So if it's in the wrong index at that particular time, like probably this past week, if it may not have earned, if you had one of these policies, it probably didn't get any interest this past week or so. It's okay. Just because you had a down week doesn't mean you have a down year or down month. You had a down week. Maybe you've had a down 2 weeks. And all of a sudden you turn around, we're in the middle of June, and all of a sudden it's like, wait a minute, your portfolio is up, 8% this year. And you remembering when it was January and February and March, like, wait a minute, we were dealing with all this rigmarole. And all of a sudden my cash value is growing and stuff like that. It's like, wait a minute. So yeah, ebb and flow of life. Don't be ready to jump off the ship because you're in some rough waters. Able to navigate in the ship, because not only does it still give you some level of covering, but you have the ability to flow and grow. Management fees. Insurers charge fees for managing your money, which can drain cash value. Now, most times it could be 2 to 3%. The same way that you go out to work, in regards to whatever your position is, or if you're an entrepreneur and you have a product or service out there in the marketplace, the same way that you charge fees, you don't sit there and get mad when you're ready to have your handout says this is my rate, or this is what I charge, or this is what I'm earning. So don't get mad when it's time for you. If something is potentially making you 10 or 15% a year, and all of a sudden they're taking 2 or 3%. I'm talking about off the whole, not off the 10 or 15% that you make. So if it's something that you're into, you start to recognize, oh, okay. So if they made me 15 cents for each dollar, and I'm being charged, 2 cents per dollar? 2 cents to 15 cents, I'll pay the 2 cents. That means I have something that's accumulating that still has generated 7 times the amount that I'm paying you, but it's my money. Don't go through life cheap. And that's why we say there are many times these type of accounts or policies are not offered to people who cannot afford them. But in some ways, Black and brown people, we can't afford them, but we have been positioned to be consumers. The people who are creators, the people who are entrepreneurs, the people who are moving as wealthy and affluent, they recognize, wait a minute, there's a reason why are we sending these people this type of money every month? Because you don't scotch them out for it. Because there are times, where you was able to buy into that piece of company or buy that piece of real estate, and it's because we had this policy. We can go crying for a bank to tell us, no, you can't have, no, you're not, you may not be credit worthy at the moment. We had this policy that was able to get us these things that are asset producing and income producing. So think. One thing about being a part of this circle, we're gonna force you to think. Think. Don't just look at the face value. Think. There's a reason to everything. So the same way that you go out there and you get the resources that you get, it's time for those management fees. Don't start scoffing. Because if you have a stockbroker or you have some sort of money manager, that's the reason they're there to hopefully make sure you make money. And as they're making you money, they deserve their compensation. Premium calls, Ms. Johnson.
Premium calls. You must monitor your cash value regularly to prevent the policy from lapsing if you skip premium.
Exactly. So that's why I said it can be considered a disadvantage. When we hear that part, when we looked at the advantages, say, oh, I can skip times, I don't have to send them no money. That's good. Yeah, that's true. But you got to weigh it out. Or even if the insurance company says, yeah, you don't necessarily have to send us any money this month. And sometimes most people who are wise, if you're moving in wisdom, be like, nah, we still sending you something. I'm treating you like a bill. Why? Because I'm recognizing you're part of my wealth strategy. And there are times where I may have to tap into that cash value and I don't need you lapsing. Yes, I know I have that option. But I'm not really going to take advantage of that option if I've been diligent and I recognize, yo, this is part of what keeps us this train moving. So yes, I know the option, but I choose not to orchestrate that option, even though I know it's afforded to me. That's what it says about weighing out the options. And sometimes we can look at the word disadvantage, oh my God, that means there's bad things. No, it's not bad things. It's just, okay. Like as I get to number 6, the tax consequences. Withdrawals that include investment gains before your policy matures can face income taxes. That means if you get to that point where you're attempting to take that death benefit to say, oh, I'm taking this death benefit because I need to take care of something over here, which shows as if like a Roth IRA. Think of it like the Roth IRA. There's a major penalty if you take money out of a Roth IRA that's growing tax deferred before 59 and a half years of age for most Roth IRAs. So you think about that same thing with the tax consequence for the IUL. You say, oh my God, I just need this because, I just need it, not for anything. I need to tap into the death benefit. The insurance company may, send that into the IRS to say, yo, they're taking this thing as, just as income. Instead of saying that they're just borrowing against it. It's a big difference.